Hey, Kevin Lawrence here. I'm thrilled to be here today with Greg Crabtree, talking about stuff in his book here, Simple Numbers, Straight Talk, Big Profits. And it's a wonderful tool. It was a contributor to scaling up as I was back in the day. And, wonderful to talk about a very simple way of looking at the numbers in a business that's required to continue to make good choices as you scale. And a lot of his work initially was started off for smaller companies, and as he's working with larger and larger organizations, much like myself. But the basic principles apply to everything. And thing we'll talk about today is that in the work that we do with clients is that and Greg, I mentioned as we were talking before about it's one CEO I talked to recently. His business, the growth stalled, and they're well into a few hundred employees and a couple hundred million of revenue and beautiful profits, like a really great business. But the business stopped growing, and I said, well, show me your strategy and show me your financials. I mean, the financials were like works of art, like intellectual masterpieces, but there's nothing that indicating the core drivers, nothing indicating, how well their people are performing versus what they're being paid, like, the labor efficiency ratio, and nothing that really indicates what's going on in a business, but an accountant would be excited. It doesn't help the leaders to make better decisions. Yeah. So we're gonna jump in today and talk into a bunch of principles that relate to continuing to scale and continue to improve the financial performance. So Greg, thank you very much. I really appreciate you being here today.
Yeah, I appreciate it. Always happy to chat. These are our favorite subjects, and and the story that you're telling is a common theme. And I'm probably the biggest critic of my original profession of being an accountant. Accounting was not designed for businesses; they were designed for accountants and bankers. And
Right.
What I've kind of strove to do in our work of simple numbers is release the numbers to tell the story. If your
Yes.
numbers aren't telling the story and a story is not a moment in time, it's an arc of time. And my numbers need to tell me where have I been, where am I at, and where am I going. And if I can't answer those three things, you need to go back to the drawing board and say, listen, we need to structure these in a different way. And I think because I went at the data with no pretext, I said,
Right.
how can we organize this to release that story to be told? And a couple of core things came out. One is forget about revenue. Revenue is vanity, as Alan Mills loves to say. And I totally agree with that. We believe gross margin, revenue minus cost of goods sold without any labor. That's our definition of gross margin. That's the true economic top line. If you actually make that one calculation across all businesses and treat it as the top line of the business, you actually put every business on an equal playing field of comparability.
Right.
And
Yeah.
and
Company
it's
I was with last week, we don't, you know what? We don't even talk revenue. Right.
right.
Well, and and we're just looking at that gross margin level, whatever your
Yeah.
like that is the top line of that business. And that number is, a couple $100 million. Now, the actual quote revenue could be a billion, but we don't pay
That's
any
right.
attention to that.
That's right.
It doesn't even exist in our financial reporting.
That's right. As a matter of fact, I've even recommended that we put a swear jar in the office, and every time you say the word revenue, you get charged $1, and you got to put it in the swear jar. We
Yeah.
only internally we should only talk margin in that process. Externally, yeah,
It makes you feel good. It's a great feel
soothe
good
your ego.
number. And
Yeah.
yeah, you
Yeah.
can talk to your fellow executives and entrepreneurs and
But
talk about how big that number is, but it's not
But one of the
necessarily
things, as I've studied the data from our client set, I've moved to since the first book, I talk about the concept of 10% is the new break even. Well,
yeah.
that was 10% to revenue. And
Yes.
that works. That works for a good bit of the businesses. But in our continued research and then my Simple Numbers 2.0 book, I go in much greater detail. But I've really gravitated to looking at profit to gross margin as the true indicator that, as I said, puts everybody on an equal playing field. And my
Yep.
rule right now is I want to see minimum 15% profit to gross margin. Your target ought to be 20% profit to gross margin, and your stretch would be 25% profit to gross margin. And if you're above 25% profit to gross margin, there's two things at play. One is you've got a short-term gain in your competition, but the competition will beat you back to that 25% level, likely. Or you are in a niche market that has no further room to grow. And so therefore now, and this is one of the errors that people, I love niches. I mean, there's riches and niches, as we've always said.
Yeah.
But when you try to take a niche market and push it beyond its barriers, that's when you start giving profit back to the field, and you take a great 35% profit to gross margin business and make it a 15% profit gross margin business, because you're just wasting money trying to, oh, we can grow it.
Yeah.
There's certain things that there's just a finite amount of demand, and there's
they're
only
rare
so many
businesses. They're rare. We have a couple businesses that we work with that would be notably higher than that.
Yeah.
But there is inherent risk in the model where other people might not want to do it or understand it, right, where it's not a niche. The niche ones are amazing, but we've got a couple, and they're very, very rare and risky. Yeah.
Well, here's the thing though that I think is quite fascinating. And so when I did the second book, I used 2013 as a base year, and then I had a started off as a 50 company model. We've now upped it to 100 companies. So we have 100 companies in this model that we track, and these are all U.S. based businesses for simplicity. But our practice is not geographic, so we have clients all over the world. But I take this U.S. model because I really wasn't getting good data from the government, economic data, and if you really learn how they gather the data, you would just ignore them anyway. But But so I said, okay, I got to get some sight on what's really happening. So we took these 100 companies. It's about 1.1 billion of revenue is what we track, and we try to make it a blend of different industries, different geographies, and we just look at what it's done since 2013 to present, and we update it every month, and so we get this kind of our view of the economic growth of the market, or lack of growth in some cases.
Yeah.
And what we've seen is, especially over the last year and a half, is this gross separation between what we call the necessaries and the discretionaries. So the economy has split into an upstairs and downstairs piece. And the upstairs piece, they're still growing at 15 to 20% revenue. This is not adjusted for inflation.
Yep.
But the downs are down 15% and not looking good. And those discretionary businesses have been hit disproportionately hard as the consumers, both individual consumers and business consumers, have had to tighten their belt and say, what can I not spend money on versus what are the things that I have to spend money on? And I'll use this as a good example of a necessary. So we have a mastermind group that we manage in the HVAC industry. And so, heating and air is kind of one of those things you need. When you're hot, you need them. When you're cold, you need them. This group, about 100 million of revenue that's in that mastermind group, they're up 66% over the last 3 years. Now, they're only up maybe 10% in headcount. So
great.
All it is, and now their profits aren't egregious. Their profits are normal. They've had essentially 56% inflation of labor costs going up, their material costs going up, their operating expenses have gone up. Everything's gone on at roughly the same rate. And so they just happen to be an industry that can pass through their cost input into price increases to stay at this maintenance level of profitability. Right. And this is what always galls me, when you got people in the media talk about, they're these greedy, people going for profit. These are people that have never run a business, because the market will not let you get an egregious amount of profit in 99.9% of the cases. There's a point that when you get egregious, the wolves come in and say, hey, a
competitor is going to come in and take an opportunity. And
that's right. But in
that case, so you're saying that their costs have basically gone up comparable to that 60-ish%.
Exactly.
And they've just increased their revenues to pass through the cost. In theory, it might not even be much more customers, more invoices. It's almost like it's a flow through of the cost in the system.
Exactly. Now,
Generally, yeah.
Now, and here's what we have watched because we're big on this concept. I mean, our signature thing is labor efficiency ratio, looking at
Yes.
margin generated per labor dollar spent. Labor is an input, margin is an output. It doesn't work the other way. And so as we've watched this, there's times that labor and margin are chasing each other up this curve. What we believe since and this was kind of the stunning thing of going back to 2013 as we studied this data forward. We saw significant growth in the US economy, much, much, much higher than what the government reported GDP growth was. I mean, really, from 2009 to 2019 was the golden decade of entrepreneurism and private business. I mean, private businesses were exploding because public company growth was, there were no net new companies in public markets. All the public companies were hiring private companies to do the things that the public companies used to do.
Right.
And so it was a glorious time. But what we saw was this 15 to 20% growth year over year during that period hit a wall in 2019 before COVID. We saw the beginnings of running out of labor in the US market in 2019. COVID just came in and threw us off the scent of the trail. And what has happened since then, if you really go back and look at total workforce participation, data, the US workforce hasn't grown since 2019. So the only thing that can happen is when labor gets short, they can demand more money. As they demand more money, I must raise my prices to be competitive or stay profitable. I go out of business otherwise. And these two, so labor, prior to 2019, revenue was the lead and labor caught up. You would add labor to catch as true growth. Since 2019, labor goes up and we just raise prices. We don't actually do more. We are mostly inflating ourselves. And if you really could truly measure gross domestic product, which is, I will grant them some wide latitude here. Measuring GDP is a hard thing in a service-based economy, so I get it. But if you could truly measure it, I don't think we've had true economic growth in the last 3 years. We've just adjusted prices.
Inflationary growth. Yeah,
it has. It has been. And I mean, I'm a chicken farmer from Alabama, so what do I know? But I mean, I think we've actually been pretty spot on with being able to watch this through this cycle because I'm looking at live data that we touch, we trust. And
you can see what's going on. And it's interesting. You bring up a point. And it's interesting is on my next book that I'm working on, I'm talking about the balance of real growth of a business and then profitability. And at the end of the day, the definition is, in the way I'm putting it, is real growth is unit growth. And in the last while, the inflationary growth is deceiving.
That's right.
And so a company I work with, and they were very successful, and the CEO is like, hey, profits are good, everything's good. We're struggling with the top line. And I had them run some quick numbers, and I said, okay, well, tell me about your unit growth. Well, it's been flat for 3 years. And they're celebrating things, but at the end of the day, they weren't looking at the right numbers. But at the end of the day, their number of transactions, which is their X in their business, their core unit in their business, it hasn't changed. But because of the price increases and all the stuff, it's deceiving. And if you manage people that handled price increases well during that time, sustained or in some cases increased their profitability. And depending on all, and I'm not saying it's easy, it's hard.
And so this goes back to, I mean, you're 100% right, because when I do my talks, I'll always ask, how many of you can measure your activity growth? And one or two people can do that. I mean, I've got a chemical manufacturing client in Tennessee. They can measure pounds of chemicals processed.
Right.
But they're one
or an accounting firm can measure the number of year ends or personal tax returns they process.
You can, but the problem is they all vary in terms of complexity. And I would contend that an hour is not a unit of productivity, because you see, when it comes
to cost,
it's right. It is. It's exactly, but it's not a unit of productivity because not all hours are equal. And I always like to say one of the core tenets of simple numbers is always isolating labor costs, because labor is the only cost that comes to work every day with an attitude. It's got
Yeah.
some good days and it's got some bad days.
Can
But
you
but
explain isolating labor costs? That's when you talk about stripping it out of gross margin. Is that why you're
Yep.
saying that?
Mhm. Right. Because, well, and if you go look at any public company's financial statements, they never disclose labor separately
Yeah.
from other stuff. They always bury it. And there's a reason for that. And so we believe in two primary isolations of labor. First is direct labor. So
Yep.
we don't include direct labor in cost of goods sold like traditional accountants do,
Yep.
because labor moves at in a different way than goods or other contracted services. And so I have to manage the leverage of that direct labor component in gross margin. But then I've got all other labor, which we call management labor. But I used to
Yeah.
call it admin labor, but the management people got offended, and that's like,
Sure.
okay, I'll just call
GNA, we
everybody
call it GNA or
labor,
SGNA
yeah,
or
whatever.
whatever it is. So if you just go
But I
back
will
up in a
tell you,
manufacturing facility, I remember one of my manufacturing clients. We knew we need to run manufacturing labor at 14%. In his model, that was the number that we knew we needed, and that was of revenue. So it would be different in your calculations.
right,
So you talk,
see, percentages are this is a slippery slope that I would redo cost accounting, and we've redone it. Here's the thing: your labor is not flexible in a manufacturing facility, contrary to popular opinion.
yep,
You are a committed labor model. You can't flex labor in today's economy. You commit, and they either produce or they don't. And so labor is an input, their production is an output, versus if you go the other way, you're saying, oh, I have this revenue. How much of that revenue do I have to spend on labor? Well, it's going to be bouncing around like this because I've got some good days and I got some bad days.
sure.
And I got guys that don't stay the whole shift when they're manufacturing. As my manufacturing clients tell me, it's like, I don't understand it. We start the line and they have to leave. And I go, no, you can't leave. We've started the line. You don't do this. And so by extracting it, so we believe in costing. I want to look at the pure just COGS of an item produced, but my labor is a constant because I'm not flexing it.
I got it. And that's why you separate it out. It's
So I
almost the
was
layer
separated out.
below the below your gross margin.
That's right.
So you're treating it almost like a fixed, almost like an
It,
overhead-esque type
it
cost.
exactly.
Got
Right.
it. And
Yeah.
then you can be, look, I got it. Okay.
Yeah. And so, and I can't tell you how many times when we take on a client, we basically undo all of these allocations and crap. I always like to say I'm an avid anti-allocator, because allocations is just a jobs program for accountants. It
Yep.
accomplishes literally nothing. And so we believe in a pure play of looking at your cost of operations relative to the margin that gets created of either what I produce or what I sell. And it is a much cleaner way of looking at it, I believe. And so we've
So
had some really good
so
success.
just to clarify this in an example. So if we were a widget manufacturer, we
Mhm.
would be looking at our gross margin we make, which is, we have our revenues, we have our physical costs of making the widget,
Right.
and then that would be like our gross margin. And then we would have production or production labor would
Production
be the
labor. Yep.
next line.
Mhm.
And so you would separate it in that way. So it's gross
Right.
margin before labor and then after labor.
Right.
And then we would get into our overheads, administrative, whatever else you would call it at that level.
Right. Yep.
Awesome.
Absolutely. And
The
now,
hard
if you're,
isolation. I got it. Yep.
yeah, and then most of, when you're manufacturing stuff that turns over relatively, 12 times a year, I'm essentially making it and selling it at roughly the same pace.
Yep.
That doesn't create a problem. In the old
But
days,
when
you
you
would
got
have a
one of these,
big
yeah.
buildup of
Yep.
inventory and a release. You got to look at some other techniques to kind of do inventory valuation, concepts with that. But what I find is when we've deconstructed those things, we've given people a different view of the true productivity of their teams. And you're not always running the race at the same time. When every time I go play golf, I don't shoot the same score. I have a personal best that I'm
Right.
trying to beat every time I tee
Yep.
it up. But sometimes I shoot 15 strokes over my personal best. Okay, well, guess what? That's the world of business every day. And I've
Yep.
got to know, I got to be able to keep score of when those things are happening. And when I become an over allocated environment, I've smoothed out the bumps in the road to
What do you
where I
mean
can't feel it.
overallocated? What does that mean overallocated?
It means I'm taking everything and becoming so moment to moment smooth of timing differences of overhead allocation, labor allocation, and all those kind of things. I'm not feeling that when am I underproducing and
Got
when
it.
am I
I got it.
straining, to deal with it.
When you get overly sophisticated financials and allocate it too much, because basically, and lots
Yeah,
of, public or even private equity backed companies, they want things to look smooth.
that's
They
right.
want
They
things
do.
to look smooth and consistent. So is what you're saying is there's exercises you can do to do that, but then you lose some
Absolutely.
of your insight and perspective.
But yeah, so this is kind of where, so one of the advantages of the way we model things is I can live with your generally accepted accounting principles or international
Yep.
financial reporting
Yep.
standard financials. I just take them and create an alternative presentation that is mathematically pure
Right.
and
For
balanced
management to make better
for
choices
management.
and a better insights and to make better choices. And that's
Exactly.
the
Now,
distinction of taking, like that client I shared up front, taking accounting information and putting it into management actionable insights so they can
that's
do a
right.
better job. That's what you're
Yeah,
essentially
you
doing.
can't
Yeah.
you can't manage a business from generally accepted accounting principles. As a matter of fact, the accountants shudder when I say this, but GAAP is more intended to hide the truth than to illuminate it. And so I got news for you.
Yeah.
And trust me, I've lived in that world, and I
Yeah.
choose to live
Yeah.
in I want to live in the productive world that creates profit and creates true profit.
Yep.
Now, we both get to the same number eventually, but I believe that there's a way to get there with greater insight and greater understanding and improve results because of it. Because I mean,
Totally.
at heart,
Because if you can't see it, you can't improve it. And that's a lot of stuff is buried in a lot of the reporting and companies we start with. You can't
it,
really tell because it's all just
yeah.
glazed over. Yeah.
Now, so we talked about this. So a lot of the companies you deal with are in that 50 to 500 million range. Now, this happens even way earlier. I mean, we're seeing businesses even at 5 million have this issue, but we try to start it as early as possible of essentially looking at segmentation of profit streams, but not, once again, trying to not get over allocated in how we deal with it. Because I remember years ago, as a young controller for a bank before I started my firm, I did the first ever branch profitability analysis. And as a good
Right.
accountant, I took the branch activity and then I allocated all the overhead, and every item on the P&L got allocated out somewhere. And I sent it out feeling really good because it all balanced, and
Yep.
everybody said, "Wow, I don't have any, you can't charge me with that. I don't have anything to do with that number."
Oh yeah.
And I was listening to them and I go, they're right. And so I went back at it and I said, okay, what are the directly associated revenues and expenses to that branch? And I'm stopping there. And everything that isn't directly associated, I'm just going to hold it below the whole group, as this is the nut that this group of this 10 branches has to get over combined, this nut at the bottom that supports
Got it.
everything.
So direct expenses of the branch and then all branch pool of expenses, almost like an all branch overhead, but at a branch more.
Well,
Okay.
really not all branch, but all bank,
Oh, okay.
and
Okay.
yeah. And so then what I did, but I had branches that were deposit generators and branches that were loan generators. And
Right.
so the loan generators had to pay for the cost of money from, um, they had to pay for the cost of money, coming from the other group. And then,
Yeah. There was yeah.
and vice versa. And
Yep.
deposit generators got the income, from the other group. So really, I mean, it really worked out great. That once I did that, they said, "Oh, this is great," and they really, benefited, from being able to see their individual, contribution. And so this is essentially, what we did then um, uh, for all of our clients, that we isolate. You kind of have step downs. Primary is revenue, cost of goods to get the gross margin. If that's as far as I can get, okay, I'll take it. and then I line that up across all the measurable
Yep.
lines of business, locations, pick whatever segment you're trying to do. If I can get the direct labor piece, that's one step further. And then if I can get individual overhead costs that are specific. And so this is really where our primary driver in segment information is turn on, turn off. If the segment goes away, does that
Can we?
cost go away? Then it
Ah,
attaches. If
right.
it doesn't
Otherwise,
go
it's the
away,
allocated ones that you're, I got it. Because it's not an allocated expense. It's a direct, like in some
no,
cases, marketing off on for that
that's right.
location
Exactly.
versus brand marketing, which
For everybody.
is, it's there no matter what. Got it.
Absolutely.
So
And
it's
I will tell you,
really, I like that off on. That's awesome. Go ahead.
and
Yep.
so it really gives you this sense. And so what I will say is that we've hit this point of the market, and like you said, where I got some things that are doing well, and I've let other activities kind of grow some weeds in their operation to where I either need to kill it or fix it. But I can't keep letting it underperform and suck the value off of the one thing that is driving
Yeah.
everything. And so we're really dug in deep on stopping low value or losing activities in that process. Now, I will say with this upstairs, downstairs part of the economy, what we found with our discretionary clients is they have actually had to broaden the number of things that they do. So whereas the necessaries, they can be hyper focused, go for the things that are really good and don't distract yourself with low value
Yep.
activities. The discretionaries have a finite amount of overhead that they got to cover somehow, some way. And so I had a client the other day that I said, listen, you need, you know, you need to find $150,000 of gross margin in ancillary activities for your business that cost us no more direct labor and no more overhead. And in a 30-minute call, we found $150,000 of things that they had been overlooking and not going after because
Got it.
they were hyper focused on trying to grow the core when their core is not going to grow. They're in a discretionary market that is kind of stalled in terms of you're not going to get any more of what you got. So let's go broader in that group.
Got it.
And like I said, this is an economy like none other that we've got two different groups that are faring differently, and you can't give one common set of advice.
It is because it is very different. So, what would some examples of industries that you've seen from your data that would be in that discretionary that probably can't expect a huge amount of growth unless they're really competitive in the market, taking clients away? What are some of what's the ones in that category?
Number one is retail. So if
Yep.
you're in the business of retail consumable goods, you're struggling.
Yep.
And you're fighting the Amazon monsters of the world that have sucked up all of the easy margin that you used to get that made covering overhead for a physical facility, easier. So
Yep.
you're going to see a shrinkage in terms of total number of physical retail stores that sell things. Now there'll be a bottom somewhere, but it's getting harder to just get enough people past the cash register
Yep.
every day to keep a door
Yeah.
open of a
As
physical
more and
facility.
more stuff, as more and more stuff is being bought online, that's why even
But
retail storefronts versus
right,
warehouses for back end logistics, there's more
right.
demand for the warehouses in real estate than there is in retail in a lot of segments because
Yeah.
the way the customers buy. Okay, so that's
Yeah,
one. What else is in
the number two group would be restaurants. So you take restaurants and put them into three tranches. You got your high end restaurants, mid tier, low tier. The the mid tier is probably at the greatest danger. Think Outback.
Yep.
That kind of group in that center. Their costs continue to escalate significantly, and there's only so much price increase the market will let them give and still be considered mid tier. And there's just only so much value. So the Applebee's, the Outbacks, and all of those guys, they're really in trouble. And I think there's what you'll see is a shrinkage as well. Talked to a client this morning, and we were talking about Cracker Barrel is a great example. They're a
Yep.
mid-tier, kind of big menus.
Mid-tier targeted middle income people. Yep.
They're struggling. I mean, they're getting
Yep.
hammered, and they're probably going to have to shrink back into their core market, but they're still going to struggle because their labor costs are going up significantly, and there's
Makes
only
total
so far
sense.
you can push your menu prices.
Yep.
Then you get into discretionary services. So from a corporate side, we've got several clients in corporate training. Those people have really been pushed off, and so they're not to zero, but it's really a, a, a muted marketplace
Yep.
that there's just not extra money in the budget, for them, to deal with.
Yep.
And so those are three good examples of,
Yeah, that's great.
does the market have to have what I do, or can they postpone it or do without it? And
Yeah, so they need to look at fund and the ones that are thriving that you're seeing in your pool of data.
yeah, so the
Which ones are
thriving, the thriving are, like we said, the necessary. So HVAC, electrical, plumbing, I mean, those guys are core. IT service companies. Although we do a lot of work with IT companies, I warn them that your customers are discretionary sometimes, and so your fate as a necessary gets affected by a discretionary customer.
right?
In that regard. We're still seeing some, you get into the bigger industries of construction. So we do a good bit all the way from GCs down to the subs, down to specialty areas, down to, we've got renovation contractors as well as new building contractors. And so once again, those are very spotty in terms of, even in strong markets, the demand is somewhat affected by obviously interest rates and sometimes just general demand. And you're not seeing consistent geographic demand. Something in California is going to be totally different than Florida,
Yep.
and so forth. So
We've seen with clients in
those,
those spaces, we've seen varying also about how focused and competitive they are and how strong their relationships. We got a couple that are doing incredibly well, but they're very focused, very competitive, and they have amazing reputations. And they've been on it, they've been pushing on it for years because they saw it coming. But the people that are just kind of sitting there, it's hard, a lot harder.
And I'll tell you, I mean, this is a hard to quantify, but I can tell you from observing it from across our client base, I would say culture in your business team matters more today than it ever has. And I'm telling you, the few companies that really have that magical cohesive culture doing common stuff. I mean, it's not like they're doing brain surgery. I mean, they're doing common everyday things, but their team is connected. They support each other. Those businesses are just off. It's almost 10 points to the bottom line.
Because they're a much more competitive team in a more competitive market. They're an aligned competitive team that are fighting together, and if they're not like that, it's harder to mobilize and win. It's interesting.
I wish I had the magic formula of making that happen, but I can tell you
that's a lot. That's a lot of the stuff out of the scaling up and getting an aligned team. Basically, you have a super focused, clear strategy and an aligned team of A players and some good reporting. It's not rocket science. It's just hard. I want to ask a question. We got just a little tight on time here, but if you were like the reporting piece, if you're just looking at a CEO and exec team in their meetings, I mean, reporting is just so it's a massive gap in most organizations. And if you were to give 2 or 3 tips from everything that you've seen, 2 or 3 things that if the CEO and the CFO and execs made sure they did in their reporting to help them, make better decisions, what's your wisdom on that one, Greg?
Well, first and foremost, we think everybody should adopt the simple numbers P&L. I mean, so our structure, we use the same P&L structure for all industries, all businesses. And so there's only 8 lines of data of input. Revenue, cost of goods sold, direct labor is the engine of the business. Then you have, in the overhead part, is facilities, marketing, management labor, payroll taxes and benefits, and then other OpEx is the catch-all bucket. We think those 5, everything fits in those 5 buckets.
Yep.
What it gives you is a picture of your engine and your chassis. The engine is revenue minus COGS minus direct labor. That's contribution margin, or what other people call gross profit, but I choose contribution margin
Yep.
as our net number. That engine, I'm going to spend 90% of my time looking at that engine and making sure that it's constantly overcoming my chassis, the overhead that is
Love that.
constantly there. It's not going to move without
Yeah.
abject decisions that I make. But the biggest weak, once I have it in that structure, then the power tool is forget about fiscal years, forget about months. I'm looking at rolling 12 and rolling 3 and a quick peek at a month just to see if there's any statistical anomalies. But I'm really managing my business on that rolling 12 and rolling 3 arc trend. And because if I don't have significant seasonality, I can use rolling 3 and annualize rolling 3 to tell me my true pace
Right.
as a business.
Right.
If I have seasonality, I have to
Yeah.
measure it in
Yeah.
context. But
Uh-huh.
then rolling
Uh-huh.
12 then becomes my friend, from that standpoint. And I can't tell, I'm amazed at how many large businesses do not use rolling 12 and rolling 3 reporting.
Yeah.
You know,
I'm amazed
but
at how many businesses, when we go to do a financial review, we look at numbers like this for the month.
but
You
but here
can't tell,
here's
you can't tell anything from here. You have no
but
context, and
but
but it's
Kevin,
normal.
here's the power number. All
Yep.
right, so all right. I I want people to remember one number from this talk. That number is 2. I need $2 of gross margin for every dollar of labor, regardless of what that labor does. And that metric, that's called total labor efficiency ratio, total LER. That metric works for 90+% of the businesses in the marketplace. I've got a
So,
$50 million chemical manufacturing client that I did the whole day with them. We put their data in our structure,
yep.
went through all that. And at the end of the day, I said, all right, guys, well, here's the deal. I'm going to leave you with this. There's only one number you guys need to focus on. And they're a $50 million business. And they got a CFO, they got a controller, they got analysts, they got a whole big team of people. So you only need to remember one number. 2. Your sales team has to sell $2 of gross margin of product every week for every dollar of labor that worked that week. And that's a win. And when you
is
don't
that
do it, you
direct
got to
labor and management labor, or just direct
direct
labor?
and total labor, all labor.
Total labor. Okay.
I don't care if you're the
All
CEO
the
of the,
humans, all the humans doing stuff in the company. Got
yeah,
it.
being from the South, we call that all y'all labor.
All y'all.
So,
Yeah. Does it
yeah.
count consultants too, or is it not counting consultants?
Yeah, just anybody's on your payroll. So just gross
Payroll.
wages, just the payroll, not allocated. Don't allocate payroll taxes. I mean,
Yeah.
remember, I'm an anti-allocator.
Yep. I like that.
I'm telling you, that is just such a magic number. The only outliers, the only common outliers, distribution companies need a 2.5 and retail companies need a 2.5 because they have heavier infrastructure costs generally
Yep.
than other companies relative to their labor input. But outside of that, I mean, you got some companies that come in below that, but those become the really ugly, unvaluable, the valuable businesses that people are going to buy. Private equity companies are going to look for. They're going to be a 2+ later total labor efficiency company. And if you can't get to that number, you're going to be the ugly duckling. And
Yeah, I'm thinking I was looking at goals for one of my clients, and we've got a goal of 500,000 of gross profit per employee.
Mhm. Yeah.
And they'll be way up on that because
but see, I will tell you, be careful. Don't measure by body. It's not about bodies, it's about dollars.
yeah.
See, dollars, this is the beauty of business strategy. I can win the game a lot of ways. And so so I just gave you the total LER metric.
Yep.
But you take labor and split it into direct and management. And so there's 3 labor strategies off of direct and management labor. I can go expensive direct labor, which means to hit my 2 LER, total LER, I got to have skinny management labor. I can go inexpensive direct labor, which means I'm going to have to spend more money on management labor to overcome their deficiencies.
Yep.
or I can go balanced between the two. And most of the industries that we have multiple data sets on, we find pretty quickly the optimal kind of neutral value of, what's the median of the high lows. But see, that's where you get to write your own playbook as a business leader, is which strategy, but I
What
can
are
win
you
both
going?
ways.
I like it.
But
You know,
that
Greg, I
is,
just love how you make it so simple because at the end of the day, it is simple.
it
And
is.
even the CEO was talking before this, that people get caught up in all the, he was talking about risk and risk consultants, and they get caught up in
Mhm.
all this complicated, they get it, it's so simple, but for
It is.
people to be able to find the simple path is hard because there's so
Yeah,
much noise and normally doesn't come out of finance and the accounting team because it needs to be the strategic view that you're talking about.
it is. Yeah.
And that
And,
is
and
great.
really, I mean, and I hate it that, I always say, the people that I struggle the most presenting my data and my information to are accountants, because I mean, they want to argue it. They, well, what about this? Like, listen, you're just overcomplicating things. The people that love what I do are the entrepreneurs, the CEOs, and and then they tell their CFOs, hey, work with this guy, and
Yeah,
I
I
want, I
want
want me
this.
some
I
of that
want
data,
this. Yeah. Well, because you're
and I'll win them
providing a
over eventually.
strategic view. Of course, you in time, but
Right.
it's my one of my favorite quotes is that I would have written you a shorter letter, but I didn't have the time. And it was
Yeah.
attributed to Mark Twain. It actually might be someone else. And that's what this is here.
Yeah.
Is how do you make it really, really simple? And it takes a high degree of mastery. But it's simple in context of making the right strategic decisions, which is what you're doing, right? That's what the
It is.
CEO
It
and the
is.
exec need. And if they've been fed all this complex information, they might not know any different. And
Yeah.
when it's
Yeah.
simple and you got a handful of numbers, yeah, that's Greg. I
Well,
just love your wisdom. Go
yeah.
ahead.
Well, like I said, we always love, getting together with folks like you, because I mean, we all live in it every day, and we're all
Yeah.
trying to, we're all beggars trying to find the bread, of how do you help make this work? Because, when we don't have a well functioning economy, we all hurt.
Yes.
And there's just so much, you know, unnecessary damage that people put on businesses for lack of just good visioning of what's really going on. And it shouldn't be that way. We've got
No,
too many
and
good
they're
data
good
tools now.
people. And they're good people with good intents. They just don't know.
Yeah,
And
that's right.
and that's why we have to keep learning and listening to experts like yourself. So my
Cool.
takeaway from this is I love the way you explain the two, and I'm running different P&Ls through my head. And that is such a
Mm,
I love simplicity because it's what scales. So that
yeah,
piece, and then the separating out of the other industry insights, but the separating out that labor piece, because we often have it called out, but not exactly in the way in some of our clients, and the 8-line P&L at the end of the day, in all of our strategic work. And I often say, and I've heard this from you before, just that we just need a P&L. It's 8 lines. Keep it
yeah,
simple. Anything beyond that is for accountants. We don't
right.
need that. We're trying to make decisions and know how our business is running.
Yeah, you'll occasionally ask a question that will require drill down, but
Sure.
99% of the time, you don't need to look any further,
No, and I'm
especially
thinking of
when
one
you
of my
see it
clients.
move. Yeah.
Yes, exactly. One of our clients, we have all of our reporting, and we were talking about this yesterday in a team meeting, is that all of their reporting across the master group and all of the units and even offices is an 8-line P&L. That's it. That's all we need. And interestingly, they have done a great job of calling out the labor, and we know that direct labor and the way they have it should run about 30%. And at some
Well,
locations, it's 40%, some it's
well,
20%. But
I will tell you. So anytime somebody looks at labor as a percentage of something, challenge them to flip the formula and make the numerator the denominator and look at it the other way. There is something magical about looking at margin as the top marginal revenue, but I'm
Yep,
going to advocate for margin. I want
yep.
margin to be the numerator and labor to be the input denominator, because that your brain interprets that differently than a percentage. A
Yeah, I'm just
percentage
thinking
is a,
that through.
a
Yeah.
percentage is a reductive mindset versus I want to grow. I mean, I want to invest. I want to spend money on labor, not cut it. Now, there's times I have to cut it if I can't get the output that I
Correct.
need. That's telling me I either have the wrong people or I didn't sell enough, one of the two, but once I get my team and I know I got the right team and they can produce, feed the bet. Man,
Yeah.
let's
Yeah.
add to it.
Double down. Yeah. Love it. Great. So for everyone, it's simple numbers, straight talk. Big, as you can tell from talking to Greg, it's real simple. And this 2.0 is actually, this is the older one, isn't it? Yes.
Yeah, that's the first book. So,
That's the first one.
simple-
2.0, I've got that one somewhere else. I grabbed the wrong one. So yeah, Greg Crabtree, thank you very much for sharing your wisdom and everything you've learned throughout your career. Great.
Good deal.
Great
Appreciate it. Anytime.
insights.
Thanks for all you do
Yep.
too.
All right.
Thanks.
All the best. Thank you.